Perfect. All right. Well, I was going to say good morning, good afternoon, everybody. Welcome to this webinar, all focused very much on green financing. It's good to see you here, a couple of familiar faces, which was nice to see. This is the fourth of 6 webinars that we're hosting as part of COP27. We've also got an in-person event tomorrow where a couple of you may be registered to attend as well. Basically focusing on how to support you guys in your net zero transition and where you want to go. So Connor is here today from EP Group, and he's going to talk you through all things green finance, which is way above my head. So welcome, Connor. I will hand over to you, and I'll shout if anybody's got any questions.
Fantastic. Thank you very much, Alan. My name's Connor Enright. I'm a consultant at EP Consulting. We provide technical due diligence, financial support, and general decarbonisation support to a range of businesses, big and small. So feel free to drop us any questions that you may have. Just a heads up for everyone on the recording. Unfortunately, I've got COVID, so if you do see me disappear off video for a second, you know why. I'm undoubtedly coughing and spluttering. But we'll get on to the most important aspects of green finance now, starting with the first, which is that this is not personal financial advice. And so please do not sue us, but we're happy to help with any questions you may have. But if you're unsure at any time, seek professional financial advice if needed. So, fantastic. The first thing is, what is the difference between finance and funding? And we'll try not to get too much into the weeds of this, but there's lots of kind of technical details around the financial world that can become quite confusing. And the key difference is that finance requires a tangible monetary return. So there's risk involved with finance. Your investment might not pay back the financier. And so in order to offset that risk, especially at scale, you need a tangible monetary return. So you usually need to pay back the amount you borrowed plus some. Funding, which might involve some repayment, but not always, does not require that you pay back the full amount or greater. So often discretionary funding could include zero interest loans, or loans where in fact you pay back most of the money, but the money is worth slightly less by the end of it because of inflation, all those kind of things. But as part of that, funding usually means that you have to provide a tangible public good. Now that doesn't have to be a direct good. It could be something like an emissions reduction, or a boost to the local economy. But usually where funding is provided by a kind of public body institution, there should be a public good provided as part of that. We'll get into the real details now, but don't be too intimidated by everything that's on the screen here. I'm just going to talk you through what these different terms are and kind of when and why we'd use them. The most simple of them, and it's in the name, is simple payback. And that's roughly describes how many years before the investment pays back, before it's black on your balance sheet, and before it's made back the amount of initial investment that was put into it. Now, this is a really useful indicator for determining the duration at which the project will impact your balance sheet and when you're going to start seeing net returns effectively. So if it's a 10-year project, but you need net returns in 5 years, then perhaps the project with that simple payback of 10 years isn't suitable for you. What it's not useful for is determining the value of the project across the whole lifespan. That simple payback of 10 years looks bad, but if it's an investment that continues to provide value to you for 30, 40 years beyond that, such as a large piece of infrastructure, like a private wire connection to the electricity grid, then you'll see that actually that project can be really quite valuable despite taking a long time to pay back. So it is a very useful indicator, but it is not by any means the only one. Another thing that makes it simple is that it doesn't take into consideration the changing value of currency. With current inflation rates being so high, having something pay back the exact same amount isn't the same as paying back that amount plus inflation, so that you effectively can buy less with the money returns. Net present value is one that's thrown around quite a lot and is a little bit more complicated to calculate. As you can see on the calculation box here, it's got a big complex equation. My advice here is wherever possible, use traditional financial modeling approaches, and most importantly, use the NPV formula in Excel if you've got all of that modeling done in a spreadsheet. And that's the easiest way to calculate it, is to let the computer do it for you. Now, this tells you the value of a project in today's money, taking into account all of the costs and all of the revenues on a kind of year-by-year basis, and how much the value as money has changed between the year of investment and the year in which those costs and revenues occur. So this is really useful for determining the value of a project across its whole lifespan, and it's also useful for comparing projects where funding is not a limit. So if you've got, you know, a big investment reserve, then you want to pick the projects with the best NPV. This will also tell you whether a project provides a financial benefit. So in theory, any project with an NPV above 0 should be invested in. However, we know that investment reserves are limited, so the higher the NPV, the better that investment is effectively. If you're looking at investing in a more limited set of funds, one thing you can do is divide the NPV by the total investment. So if your NPV is 5 million and your total investment is 2 million, then your NPV quotient, as it's called, is 2.5. And what that does is it lets you work out what the value of something is relative to what you've had to spend to get there. So where you've got limited funds, that can really help you to decide which ones to go for. This is not useful for determining the duration which a project will impact your balance sheet. That's where you'd use a simple payback. And it's also not useful for simple projects without a full financial model. From NPV onwards, you really need to have some idea of the costs and revenues. They don't have to be exact, but you need to outline your assumptions and make sure that you've got as much sight as possible of all the costs and revenues within that financial model year by year. So where NPV tells you what a project's value is over its whole lifetime as a sum, the internal rate of return is another popular indicator for total project value, and that tells you what it is on a yearly basis, as it were. And again, once you've got a financial model, it's quite simple to calculate if you use Excel's IRR formula. If not, you can use this formula here where you're summing over the years. And the idea is that you set your NPV to 0, and that gives you an IRR, i.e. how much money per year would this generate for you. So this is useful for determining whether this project is better than other investments available to your business. And it's also useful for setting a kind of minimum profitability for your project pipeline. So if you've got one large scale investment that you can keep investing in that provides you an internal rate of return of 5%, and you're looking at other projects that you could invest in, if they give you 5% or less, you might as well have invested in that larger project. So this gives you quite a good idea of what different projects are worth if you kind of spread those returns over the lifetime. What it's not useful to, again, is determining what the net contribution to your balance sheet is when that becomes positive, but also it doesn't always tell you where those returns happen. So in some projects, it might be that you buy an asset, it gives you efficiency gains, and then you sell an asset. Now your returns for the first part of that project where you're operating the asset will look lower because a good chunk of that return comes at the end when you sell your asset. So looking at your IRR in context with your financial model will tell you when the relative returns happen, and often it's advantageous to get as much money back as close to the start of a project as possible, such that you can invest it again in a different project. And again, this is not as useful for simple projects that don't have a full financial model. Final aspect to consider in understanding project value are the kind of multiple benefits, or the environmental, social, and governance benefits, or the ESG benefits. And these tend to be outward-facing benefits, such as carbon abatements, air quality improvements, health and well-being. They could apply to a wider public, or they could apply to your employees. And so these, along with the kind of multiple benefits of energy efficiency around quality, cost, time, and safety, can provide a direct financial benefit to your business. And sometimes where a project looks like it might just worth your while, considering these benefits will help you to take a more holistic view and decide whether it is in fact an investment worth proceeding with. And so it's quite useful for leveraging additional investment or funding from approaches such as carbon insetting. This is where you take these aspects and you sell them, or you trade them with companies in return for some finance. It's also really useful for communicating your impact and for managing your reputation and your political risk, particularly if you've got a lot of sight within the public or within the political sphere. It's not useful for comparing your core assured revenues, so the kind of level at which you can say accurately this is going to be worth £500 a month for ESG aspects tends to be lower than for things like energy savings or avoided costs. So you don't want to pin your project solely on these if there's not enough of a kind of core revenue set to support project otherwise. It's also not useful for projects that have low impact or have an impact that isn't verifiable. So if you don't know what's happening before a project happens, then it can be quite difficult to prove a carbon saving or a ESG improvement afterwards. And of course, not all projects actually provide a positive public impact. Excuse me. So building a private wire grid for your company to avoid network charges in an area that hasn't got any constraints doesn't really help the public, and so you can't promote that as an ESG impact. It might offer you some internal operational benefits, but it doesn't necessarily have a reputational benefit. Fantastic. So the final thing to do when you're considering your project value, and those four indicators we just discussed are the ones that I would think about most of the time, but the final thing to do is to summarize that. And so I've just provided you a very simple summary structure here. We can make these slides available to yourselves, and you can take this home and use it as you need to. But when you're going out to financiers, it's key to note that although you've got these very important numbers at the top here, a lot of the things that they'll be looking into and diving into in depth are those assumptions there, because obviously all those numbers come from your financial model, and so understanding how you've modeled your new asset or your new investment will be key for determining whether they agree with those outcomes, with those numbers there, and whether they think it is in fact a investment that provides a 20% internal rate of return, which is very good, or whether that internal rate of return is actually lower. And so good modeling really supports a lot of the engagement with investors. But the investors should be able to help you here as part of their internal quality assurance. They'll tell you what is good and bad about your proposal and the way you presented it, and if they think any of your assumptions might need to change. So don't forget that this is a format to start that conversation with your financier or your funder, and really that is a discussion that should go both ways. So I'll just pause here. I've got a couple minutes for any questions if anyone has any. Just stick your hand up or shout out, and Ellen will highlight them if I fail to spot you. Also gives me a perfect opportunity to sip some coffee. Okay. Stunned silence could mean one of two things. If you do have any questions, feel free to put them in the chat or save them up to the end. Hopefully we'll get some time at the end to walk through. I think what you really want to know is less about the individual numbers and indicators that go into green financing and working out what investments are best. And what you really want to know are the funding options that are available to you. So I put together this little graph here, this little diagram to show the 6 options that I'll be presenting to you today. And you can see on the bottom axis, we've got internal versus external investment. So the further left you go, the more of your own money you're going to have to put up. And the further right you go, the more a external financier will fund or finance a project. Now, as we know, in return for that finance, they'll be expecting a return. And so as you can see on the vertical axis, we've got the sharing of benefits. And so self-funding, you've got full benefit retention. All the benefits are yours. You can do with what you will. When it comes to grant funding and carbon insetting, these are all about providing a good, something beneficial either to a public or another member of your supply chain. And usually here you'll have to share your ESG credentials. Now, it might be with grant funding that those belong partly to you and partly to the grant funder, or that you both simply take credit and there's no kind of accounting there. But with carbon insetting, there is very much an aspect of ownership to those credentials that comes in return for part or fully funding your investment and your energy improvement. Now, on the right, we've got traditional financing approaches. So debt finance, equity finance, which is using shares and other corporate ownership instruments, and then performance contracting, which is a little bit different from the other two, and that's where the delivery is assured on your behalf. But we'll get into each of these as we go. And again, if you have any questions, feel free to note them down or stick a hand up and we'll pause halfway through. So for each of these funding options, I've put together 2 or 3 key questions that you need to have a think about. So the first option we'll discuss is self-funding. Here, the funding comes from your internal cash reserves, and this will enable greater flexibility. It means that the cost of the capital is reduced effectively to 0 or whatever return you could have had from putting it in a bank or another investment. And so that means that the cost of the investment overall decreases, as it were. The key things to think about is, do you have enough money to run through the whole project? And you might need a bit of headroom here in case some project costs change. And is this the best investment for your organization? Can you make more money elsewhere? And the way you do that is you look at hurdle rate. So like I said, if you had an investment that you could continue to invest in for 5%, everything else has to beat that 5% rate in order to be more worthwhile your investment and your limited cash reserves. But we've got some other questions here. Now, you want to think about what proportion of the project costs because your organization commit, and often you'll be expected to self-fund the least profitable, most risky parts of a project, an investment, such as the kind of project development and the initial development of the concept and feasibility mapping and all that kind of stuff. And you can get some services like facilitation that will help you with this, and that can really help make your self-funding go further. You also need to think about how your funding commitments might change over the development of the project. If you're going to need a little bit of money to start with and then a big chunk and then a little bit of money moving forwards, or if it's going to be a big chunk up front and then it peters off over time. That's a key thing to think about when you're looking at your budgets and you're looking at your balance sheet moving forward. The other thing is, will you have access to additional funding if needed? Have you got a cash reserve that could be deployed, or are there certain thresholds at which you might need additional funding, such as a change in energy price, and where might that come from? So really, contingency planning is key, because with self-funding, all of the liability sits on you. It's your money, and no one else is going to lose it apart from yourselves. You might want to go out and get some funds from an external organisation, and that's where you look at grant or discretionary funding, which is provided by a public body institution. So it could be a charity, a local development organisation, such as the New Anglia Local Enterprise Partnership, or a municipality, such as a local council. Usually this funding comes with conditions, which can be more or less rigorous depending on the scale, but it almost always requires the provision of a public good or some match funding from yourselves. So often when you're talking about grant funding, it is in fact a form of self-funding, although with some assistance, centralised assistance. And here we've got 3 key questions. Is there enough funding available to cover the project budget? Sometimes there'll only be a 25k max grant, and if you've got 100k investment, you might have to find the shortfall. Does your project provide a necessarily public benefit, and is that the kind of thing that your funding institution is looking for? Your local business support group might be less interested in emissions and more interested in how many people you'll employ, additional people you'll employ through your project. And so you need to think about whether you can satisfy those different parts of the eligibility criteria and whether you can satisfy those within the time frame. Often there'll be key milestones at which you need to report, or perhaps funding will be phased, so that the first phase is quite light touch, and you need to have some solid outputs ready for the kind of implementation phase or the second phase of funding. Other key questions include, does this cover capital costs only, or the project development costs? Often those project development costs are riskier and end up getting shouldered by yourselves as businesses or organizations. You got to think about the match funding if there is any, and also the payment schedule. Often grant funding won't be able to provide retrospective funding, so for a project that's already underway, and often you might have to show what's called defrayment, so that you've actually made the purchase before they'll give you the money back. So that's another important thing to think about in terms of budgeting. You also need to think about how long it will take for your application to be confirmed or rejected, if you can pursue multiple grants, and if they'll exclude you from one another. And it's also worthwhile thinking about alternative plans if you can't achieve the desired level of grant funding, particularly if you're further along project development timeline. Fantastic. Now we get to the more kind of tangible sharing of benefits, and that's around carbon insetting. So this approach trades verifiable environmental impacts, mostly greenhouse gas abatements or emissions reductions, for full or partial funding of the project by another organisation. Usually that organisation will be within your supply chain. That way those emissions would effectively be passed on to them anyway. They've also got a good relationship with you to begin with, to kind of evaluate and understand the project and its impacts. This is a great option if your project provides verifiable greenhouse gas abatements, and if those abatements are cost effective compared to other investments in the supply chain. So if you manufacture cement and there's a fantastic opportunity to reduce the CO2 of your cement, it might be cheaper to invest in that than to invest for other constructions in more efficient cars, or other companies investing in more efficient trucks and production processes. So where you are a more cost-effective measure, that's an opportunity for you to go out to your supply chain and say to them, look, we've got this great opportunity. You can have some of these greenhouse gas abatements, and we'll have some money to fund an improvement that saves us energy and cost over time. The key aspect there is that they have to be significant. So probably not 5 kilograms of carbon, we're probably talking 5 tons plus. So they need to be significant, and they also need to be verifiable. So you need to be able to demonstrate where those came from. And there's often a cost that comes with that verification. And so you need to make sure that your project can serve that cost as well. And that can be quite a cost intensive thing to do, especially if it's a multi-year project and you're expected to verify those for 10, 15, 20 years plus. So have you got that abatement, and is it cost effective? Are the key questions here. But other questions include, are other supply chain actors looking for your carbon insets? If they're not, you can perhaps think about expanding your scope, looking at different parts of the supply chain or your neighbours perhaps. Again, you've got to think about the verification of that impact and its cost. And whether you're really happy to relinquish the environmental and reputational benefits of your project. That's why a lot of us are doing carbon saving projects at this point in time. And once you relinquish these, you can't claim them back, revoke them, or double count them. So effectively, in your reporting, you have to make it clear that this was something that was triggered partly or in full by an external investment. And there'll be a contract that says who gets to report those in reporting systems, such as the central, the compliance systems set up by UK government, and also centralised systems such as the Carbon Disclosure Project, or CDP. But in some ways, it can be better to trade those environmental credentials for than it is to trade out some of your monetary return. And again, you need to think strategically about why you're making these investments. Is it primarily for a reputational aspect, or is it to reduce some of your costs and to provide benefits to your organization? And if it's we're really talking about reducing costs, then sometimes these insetting approaches are better than sharing your financial return, as you get with these next few options, the first of which is debt finance. And this is probably what we're most familiar with when we talk about funding and finance. This is a traditional loan, usually secured by a valuable asset your business owns. So that could be some property, it could be a large piece of machinery, could be vehicles, so on and so forth. This finance can be provided by almost anyone, perhaps a bank, another business, or one of your peers, either as a personal level or within your supply chain. And so this can be quite flexible to fit in with other forms of finance and to operate at different scales. The key questions here are, can your organization accept debt? And have you got enough assets to back up that debt? Some companies, such as in the charity sector, community interest corporations have got limits on the amount of debt that they can accept and the returns that they can pay. And some legal forms do not allow you to offer your assets as collateral for a debt because it's a charitable structure, and those assets need to be protected in the interest of the charity and the people it serves. The final question, and this is often much more important, is the liability acceptable for your business? Debt finance will show up on your balance sheet, meaning that it'll make it more expensive to access further finance because financiers will look at your balance sheet of what you own and what you owe and see that you're already paying out. Effectively, there's less meat on the bones for you to pay back their returns over time. And also, if you're running a company with personal liability, or depending on your legal structure, you could be liable to actually pay back business debt if your business is not able to. And so that's something to think about, and that you might need to look at getting some financial advice on, depending on the scale of investment that you need. If you're a charity, again, you need to consider whether your financier will be happy limiting the repayment of their loans. So for community interest corporate companies in the UK, the interest payable is usually performance related, and the interest is capped at 20% of the average amount of company debt in a previous year. So you can't provide unlimited returns to them. You might not even be able to pay back in 3 years, even if the project is really good, because there's a limit to the amount you can pay back per year. So those legal structures will be key in determining whether you can get debt finance. You should also think about things like the tax deductibility of repayments. That can be really beneficial and can actually lower the effective cost of debt finance significantly. Sometimes, again, debt finance will only cover capital costs because that's the asset that they can take back and sell if everything goes wrong. And so you need to think about whether the debt financing will cover both capital and project development costs and what kind of assets are available to you to begin with to secure that debt. Fantastic. Lovely. I've been talking very quickly, and I've got another 2-minute break or pause for questions scheduled here. So if you have got any questions, feel free to stick your hand up now or shout out. I'll get back to you.
I can't see any.
That's fine. Clearly, it's just so engaging that all the questions have been answered already.
We're bamboozled, Connor.
Again, if there is anything here that you don't understand, don't be afraid to stick your hand up and just say, can you go over that one more time? Can you tell me a little bit more about this or that? Finance is a often deliberately cloudy world. And so if there are any clarifications that you want, any terminology explained, just let me know. More than happy to do that. And I'll try and slow down a little bit here now that we're slightly ahead of time, and run through this as succinctly as I can. So the next option that we're really looking at is equity finance. So equity is all around the ownership. And so this considers how you raise funds through selling shares or private placements of part of your company, so trading some of the ownership of your company and its assets with the financier. So that could be a private placement with investors, or a public placement with investors, or a private placement with shares. And so this considers how you raise funds through selling shares or private placements of part of your company, so trading some of the ownership of your company and its assets with the financier. So that could be a private placement with investors, a public stock offering. And often when we talk about crowdfunding, it's actually talking about a kind of public equity offering in this way. Again, we've got two key questions here. Does your company have shares currently, and can it offer or distribute shares? Not all company structures give you the ability to create and distribute shares. And so if you are one of those company structures that doesn't have that, unfortunately, equity finance is not something that you can consider at this stage. The other aspect is, do you want to share your profits moving forward? You know, if you're offering 10% of your company out, then you're effectively offering 10% of your profitability and 10% of the control, perhaps, of your company to an external investor. And so you might not want to share that control, and you might not want to share those profits moving forward. But even if you are sharing those profits, again, some structures will limit how much profit can be made and how much of that surplus or profit can be given away in a dividend. This is particularly the case for charitable or community interest, legal forms. And so looking at the caps that exist on the sharing of profit and how this will influence the amount of finance you can access and how long you need to repay that will be a key consideration. Another key consideration you should bear in mind is having an exit strategy. So often you'll be able to discuss with your financier and say, okay, the term of payback for this investment is 10 years. Is there a way on the 11th or 12th year that I can buy my shares back, you know, with a return or an inflation adjusted rate there? And so often, if you want to maintain control of your company and full ownership of any profit in the long run, having an exit strategy will be key. And obviously there will be a return that's paid to the financier as part of that exit strategy, but that can often be worthwhile to regain the ownership of your company in full. Again, it depends on your structure, the kind of rights that come with shares, but it's important to consider those aspects around ownership and control if that is part of the kind of equity offering that you have. Equity tends to be used by bigger corporations because they have shares to begin with, and there's often already a market to buy and sell those shares. But for smaller finances, for smaller companies, it is an option to consider. It's also an option that can be combined more easily with other financing approach. Traditionally, debt and equity financing go hand in hand. And so you should look at perhaps whether these two can be used together. There are a load of really complicated instruments that can be used around equity and the sale of equity. And there's a class called quasi-equity instruments, so preferred stock, convertible preferred stock, convertible loan notes, equity units, common shares and warrants are all different forms of equity. So there is a higher level of complexity here. And this is something that you should probably discuss with your CFO if you have one, or with a financial advisor if it's something that you've never come across before and want to explore in real detail. Fantastic. And now we'll get on to the last of the financing options, and this is a new kind of business model, often described as performance contracting or an as-a-service model. And this is where a company comes in and delivers a project on your behalf. So performance-based finance doesn't usually require any upfront cost, sale equity, or doesn't impact your balance sheet. So there's no loan or debt that occurs on your balance sheet. Instead, a delivery organization manages the delivery and the quality assurance of your project. So making sure that a good project is delivered, that will pay back. And in return for that service, they will take a chunk of your project's net savings. So you will see some savings, but it will be a much smaller proportion or a smaller proportion than if you delivered the project yourself or through a facilitation organization or a different approach. The assets might be owned by the delivery organization themselves. So they might come and put solar on your roof, and that is their solar, but it's still your roof. Or it could be owned by the client, so that they might come and give you a piece of equipment with kind of set operation and maintenance schedules, and in return you'll pay back a proportion of the savings generated by that equipment in order to cover the initial cost of developing that project and installing the equipment. It really depends on the exact business model, and there are different companies offering different variations of this, including EP Connect, which are one of our sister companies that offers a form of quality assured delivery through the ESCO in a box model. So if this is something you'd like to discuss, please do drop us a line. With these kind of as a service models, the savings or the environmental benefits provided, they're provided as a service in return for that regular service fee, or for a regular share of the savings, and that's often less than the total value of the savings. So you effectively see a net benefit and some environmental credentials in return for letting someone else come and run a project and take some of the profit. So the key question really is it worth sacrificing that proportion of the project savings, proportion of the project in return for a lack of an upfront cost, and ensuring that there's no balance sheet impact? That'll vary from business to business, depending on what your investment reserves are, what the asset is, and whether it's the kind of thing that you'd be able to manage delivery of anyway. So if you want a quality assured delivery, if you want someone who will ensure that you get good contractors, that they've installed everything as much as possible, at the highest quality as possible, this can often be a really good model. And so if you don't perhaps understand the technical complexities of the project that you're thinking of investing in, this is another thing to consider moving forward. However, there are often facilitation organizations that could provide some of this quality assurance at a lower cost. So New Anglia LEP is one of those perhaps, and they've run a range of schemes that can help you to consider whether your net zero investments are high quality, and what the kind of savings and environmental impact are. And if you have any questions about those, I'm sure Ellen can help answer those as well. So really, you've got to think about other things to think about here. Are there additional benefits? So if you get LED lighting installed, will that give you a comfort and a safety improvement for your employees? Will they provide additional services within that? Often they'll provide maintenance and operation, and the measurement and verification, and the monitoring and reporting of a project impact on your behalf, because those are all aspects that ensure the project works. And if it doesn't work, they can work out whose fault it is perhaps, and why that has gone wrong. In terms of whose fault it is, this is a key consideration, particularly if you're changing how your business operates frequently. So if you're producing something and that production changes frequently, there might be a dispute with the contracting organization around whether the savings didn't occur because something changed in your production schedule. So perhaps you started producing more cars, and so you used more energy and saw less savings, or whether there was something there that invalidated the kind of the technical base of the project. If you stopped using LED lights that had just been installed, that might cause a dispute with the organization that's delivered this. And so it's really key to understand what recourse there is for you as a business to resolve those disputes, and who will be part of the process that resolves that dispute. Sometimes there'll be an independent body, sometimes it will be the organization that you're contracting with. And so they might have mixed incentives to resolve those disputes in favor of one party or another. There also might be different options around the timescales for implementation, because it might not be fully in your hands. So if you've got planned downtime that an investment needs to align with, or an installation needs to align with, this is something else to consider. Other things to consider are penalty clauses, how much operational control you would have, and who would own the asset on the conclusion of the contract. And so these are all things that need to be discussed with the individual service provider here, because there are so many different business models that come together. But really, we want to understand when we engage with the financier, how can we tell if their offer is good? And so often we'll be talking around things like loan or finance terms. There are three things here that you should really keep at the front of your mind. The first of those is the interest rate. So this effectively is the increase in balance that you're required to pay each month as a portion of the borrowed amount. So that could be fixed for the loan terms, or it could vary alongside the Bank of England's base rate. That aspect is really important at the moment with the way that the base rate has varied, and the fact that actually the cost of capital has increased a lot in the last few months. And often that's not in your control. And if you've signed up to a contract 3 years ago with a variable interest rate, you won't necessarily be able to forecast how that cost of capital changes, and suddenly you could see spikes in the cost of servicing that debt. So the wider market does influence your repayments, and so it's key that if you're looking at loans that might be difficult to service, that you've got some concept of contingency plans or cash reserves, or perhaps even reducing the amount that you're borrowing to give you a bit more headroom for those changes in interest rate. It's also key to make sure that your project provides enough savings above that interest rate, such that if it changes, that those savings will be delivered. An interesting factor here is that actually a lot of the inflation at the moment is driven by the price of energy. And so that type of inflation might not impact energy saving projects as much as other forms of borrowing, because as your cost of energy increases, your effective savings increase as well. And so although you might have to pay back more money, you're effectively saving more money with each day that the energy price inflation occurs. But you also need to think about when you're repaying things, and that will be outlined in your payment schedule, or your repayment schedule, actually. So that determines a proportion of the loan you need to pay at specific times. So you want to align that with your forecast cash flow. Sometimes you might have a big installments to pay, and so you might need to effectively save up for those. Sometimes it will be a big chunk at the start or the end, but often it's just even amounts spread out throughout your the terms of your loan, and so you need to make sure that those align with your revenue forecasting and when you've got sufficient cash in. Some lenders might allow you to defer or to take a repayment holiday to manage cash flows. So if you don't have enough cash one month, you can effectively defer payment for that month, and then save up a bit, and then you've got some reserves next month to start your repayments as per usual. There's often a cost that comes with that repayment, so your interest will have continued to tick over in the meantime. So deferring repayments too far is not always the best financial decision, but equally your bank is kind of counting on those interest rate increases, and so that forms part of their profit. So if there may be a penalty for early repayment. So if you want to repay your loan early because you've got a large bit of revenue come in, there might be a penalty for doing that. Often that penalty may or may not work out better than the cost of paying back over time anyway. So it's something to consider. And the final thing to consider is payment schedule, which is when you will receive your money. Some finance might not be paid out until the installation is being completed and until someone's come in and checked that installation was good quality. Because if it wasn't a good quality installation, it won't provide the returns you were looking for, and therefore the bank won't be able to get its money back in the end. But that does mean that project development costs and defrayment, which is that initial expenditure on the asset, whatever that is, might need to be self-funded and demonstrated in the short term before your financier will pay out the money. So this is something to discuss, and having a personal relationship with your bank, with financiers, will help you to talk through these things, particularly around payment and repayment schedules, because that's often where the most latitude is, with interest rates being often set by the wider market and different forms of investment that bank has available to them. Fantastic. So here's the final few considerations for looking at finance more generally, and this applies to kind of all finance rather than more specifically to loans. The first of which is security. So that's a property that you use to assure the repayment of the loan, and that is at risk of repossession if you don't meet those repayment terms. Although again, there might be some latitude for repayment holidays or discussion with the lender. Adding security usually lowers your interest rate and will unlock additional finance. So you can borrow a large amount, but again, you've got to put more up front for that. And that is a risk that you effectively share with the financier. So if you're putting up your business property that you occupy as part of that security, then that could have a really key impact on your business if that there's an issue with that investment, if those repayment terms can't be met. And that's part of what we call the liabilities for yourself, excuse me, as a business. It's basically any impact that comes from defaulting or missing repayment terms. So you could be held personally liable depending on your company structure. So that means that they could pursue you and your personal assets, your home, your car, so on and so forth. But often it really impacts your business's balance sheet and your business's credit score. So its ability and the cost at which it can access finance moving forward. You might also be liable for the upkeep of the asset or for the collateral which you've used to secure the loan throughout the loan terms. So if you have a car that's been used to secure a loan, and then halfway through that car gets written off, or you forget to take it for an MOT, or the tyres perish, you might not be able to use that as security, and there may be an impact on your liabilities. Equally, if the thing that you were borrowing against was that car, and that car is no longer providing a useful service and return to your business, then you might still be held liable for the lack of upkeep of that asset by the financier, and that will affect your ability to repay the loan. However, it's not all negative. Often financiers will provide additional support and due diligence. So they'll look at your project. They'll say, is this good quality? You know, is that contractor got a good track record? Has that contractor got a good credit score themselves? You know, if they go out so if someone retires tomorrow, will they go out of business and perhaps leave your project unfinished? They'll effectively verify the quality of your proposed project as part of the financing process. That can give you some peace of mind that the savings will be sufficient to ensure repayment, because that's what the finance is there to look at effectively. Some finance solutions will also help you to resolve disputes around whether an asset is operating as specified, particularly if that's around an installation or the maintenance or something that was provided by an external contractor. So these dispute resolution mechanisms can really help you in the worst case scenarios, and they'll help you to assign performance risk both at the start and during the terms of a financial offer. So who's responsible for what, making sure that those incentives are aligned so that the contractor does want to come in and carry out good maintenance, so that if that you as a business are incentivized to maximize the savings, and the financier is incentivized to develop a good quality project or provide a good quality outcome as a result. And this really just protects your business from paying for a substandard technology design or installation. So sometimes it can be advantageous to get in a financier or a finance offer that isn't coming from the delivery organization. So if a contractor comes to you and says, we've got this great new heat pump, it's going to be suitable for your building, and we can get it financed tomorrow, that might not be as useful as having someone else finance it, come in and look at your building, come in and look at the heat pump that's offered and say, actually, you really need to do insulation first. This isn't going to provide any savings, or I think this heat pump is too big or too large for what you need it for. This isn't the investment for you. So finance is something that provides a benefit to yourselves. This is my last slide, and then I'll flash up my email and you guys can ask any questions that you've got. But these are all ways, we've spoken a lot about risk and what risk there might be for your business in engaging with finance. Fortunately, risk is part and parcel of the financial world, but there are ways that you can understand, consider, and mitigate those risks so that they've got a lower likelihood of happening or a lower severity if they do occur. Some of these are around making sure that you've got a high quality project to begin with. So using a certified contractor, someone who's got Trustmark or MCS certification, and who satisfies the manufacturer's warranties is always a great place to start. A use of a facilitation organisation such as New Anglia Local Enterprise Partnership, or other groups such as the Carbon Trust, so on and so forth. And this will ensure that there's enough technical expertise to manage the delivery and development of the project, to understand whether the technical design is good, strong and suitable, and to resolve any disputes that might come out of this. The use of performance contracting aligns the incentives between the organisation that's delivering the project and yourself, who has to pay those back, by making sure that the savings are as big as possible and that they're as shared as between the two organisations, effectively aligning those incentives. Monitoring the progress of your investment is always a good idea. And that allows you to spot and resolve any issues around operation and maintenance at the earliest opportunity. Or if you need to highlight something that you do think has gone wrong, then you want to do that at the earliest stage. And that will just help you also to improve the efficiency gains that you get from your project. Along with monitoring is the slightly different measurement and verification. And this is a statistical approach that's provided by facilitation organizations or performance contracting organizations. And this basically says, do we have enough data before or after to determine what the project's impact has, how much energy and cost it's saved. And so having all that data there is really helpful for considering the risk involved and making sure that you can work out what's happened where. And throughout, you want to have contingency plans. So things such as cash reserves, legal recourse, or access to centralized support if a project does not provide the expected benefits or returns. Finance is all about risk. And so with each of these projects, there's always a chance that something should go wrong. The important thing is to make sure that you as a business aren't left holding all the ropes if that does happen. And so contingency planning is key, and that's something that a good facilitation or consultancy can provide as part of its service. So here's my email. Do drop me a line if you'd like to discuss any projects or if you would like a copy of these slides. And I think we've got 5 minutes now for some questions, if there are any.
Thank you, Connor. That went largely over my head, but it was very interesting. Thank you. Has anybody got any questions for Connor? He's a very smart man. Stunned silence, Connor.
Yeah, so if there is anything you would like clarified, we can go back to some of these slides. We can spend a little bit longer on concepts. If there are any of those financing options that you've been thinking about and you want to discuss more, feel free to raise it now.
I can't see any hands, but I'm hoping that's given you guys some food for thought. It's certainly a lot of detail. There's a lot there, lots to think about and consider, absolutely. So I would like to take this opportunity to thank Connor and just mention that this webinar is provided as part of the UK's government's Community Renewal Fund. I should have said that at the start, so apologies for that. And just to let you know, there's a couple of other webinars. Connor will be back on Friday looking at supply chains and ESG. And we've also got Andy back on Wednesday looking at carbon footprinting. So I think if there's no burning questions and I can't see any hands, I might draw it to a close and just say thank you very much again, Connor, much appreciated. And we will see you all again maybe on Wednesday. So lovely, or in person tomorrow perhaps. So it would be nice to see some of your faces in real life. So I think if we're all done, I will draw that to a close. So thank you very much.
Fantastic. I'll put my email in the chat. If anyone has any questions that they want to follow up offline, then feel free to. And have a great day, everyone.